Imagine this. It's a Tuesday night in 2025. Bitcoin has just bounced back above $90,000 after another violent dip, and your phone is lighting up green. Your Binance Futures P&L shows plus 240%. For a moment, you actually feel taller. You start thinking about quitting your job, upgrading your car, maybe even messaging that one friend who told you crypto was gambling, just to send a screenshot. Then you go to sleep with your 50x long still open. At 3:17 a.m., while you are dreaming about your new life, a single candle on the BTC chart wicks down a few $1,000s in seconds. You do not see it. You do not react. You just wake up, grab your phone, refresh the app, and the number on the screen is no longer green. It is zero. Position closed. Liquidated. Again, if you have ever stared at that tiny word liquidated on Binance Futures and felt your stomach drop, this video is for you. In this video, we are going to break down why so many traders are getting wiped out in this 2025 bull run and why you might be one of them. And more importantly, how to finally stop it before the next move erases your account. We will talk about the hidden trap of high leverage, the psychological loop that keeps you repeating the same mistakes, and a simple way to trade this bull run without becoming free liquidity for whales. By the end, I want you to see every futures position differently, not as a lottery ticket, but as a decision your future self has to live with. Let me tell you a story that might feel uncomfortably familiar. Liam is not a full-time trader. He has a decent job, a family that loves him, and a quiet dream. If he can grow a serious futures account in this bull run, maybe he can finally buy a house without a 30-year mortgage. He first heard about crypto years ago, when Bitcoin was still under $30,000, but he ignored it. It felt too strange, too risky. Then, in 2025, everything around him changed. His group chats are full of charts. Clips on TikTok and YouTube Shorts scream about simple Binance Future strategies and zero liquidation tricks. He sees screenshots of PNLs that look like lottery wins. Plus 500%, plus 1,200%, numbers that do not exist in his normal life. At first he scrolls past them, but then Bitcoin breaks above $100,000 again, and suddenly the fear of missing out is louder than his doubts. StatMuse +1 Liam opens his first Binance Futures account with 500 USDT. He does not read the docs. He does not watch the full-length tutorials. He finds a short video titled, How to 10x a Small Account with Futures, and follows it step by step. Cross margin, high leverage, tight stop, tiny time frame. The first trade happens to work. The candle moves in his favor, the unrealized profit spikes, and within minutes he has made more money than an entire week at his job. Something inside him clicks. Over the next few days, he strings together a series of wins. Bitcoin keeps bouncing, altcoins are flying, and every small correction gets bought quickly. Then comes the night that changes everything. Open interest across the market is at record levels. Futures volume is dwarfing spot. Price action is sharp, gaps are brutal, and liquidation clusters are stacked on the chart. Traders all over the world are leaning into leverage, convinced that this time, finally, the only direction is up. Be in crypto +2 CoinGlass +2 Liam watches Bitcoin push up, hesitate near resistance, then push up again. He tells himself he will wait for a pullback, but the candle breaks the level in one sharp move, and he cannot stand the thought of missing it. He market buys a large long on Binance Futures at 50x, using almost his entire balance, just for a quick scalp. For a while, it works. The price moves his way, the position is deep in profit, and his brain starts planning the next move with an even bigger size. Then volatility hits. In a single violent wick, the price snaps down, triggers cascades of liquidations, and wipes out more than $1 billion in leveraged positions across the market. Liam's trade is one of them. His account is reduced to scraps. Be in crypto +2 crypto briefing +2, he stares at the liquidated notification with a tight chest. He tells himself it is just bad luck, that the exchange hunted his stop, that whales manipulated the market. He does not want to admit that he did not measure his risk at all. Instead of closing the app and walking away, he tops up his account from his savings and goes back in, determined to win it back. Weeks pass. The same pattern repeats with different candles, different coins, different narratives. ETF headlines, having narratives, new meme seasons, quick crashes, and violent recoveries. Each time the story is slightly different, but the result is the same. When volatility spikes, Liam is overexposed, overleveraged, and emotionally attached. He hesitates at the exact wrong moment, and liquidation does the job he refuses to do manually. Liam is not a villain, and he is not stupid. He is doing what most people do when they are dropped into the fastest casino in finance with no training. The problem is that in this market, the cost of learning the hard way is measured in real money, real time, and real stress. If you have ever watched your own account follow this arc, small wins, growing confidence, bigger size, one massive wipeout, then a fog of denial, then you already know Liam's story. It is not about a single terrible trade. It is about a structure that almost guarantees that, sooner or later, liquidation will find you. So why does this keep happening? Not just to Liam, but to the majority of traders who touch Binance Futures during a strong bull run. The first layer is personal psychology. The moment you see a triple-digit percentage gain on a single position, your brain is no longer in rational investor mode. It is in casino mode. Fear of missing out pushes you into trades late, when the move is already extended. Greed keeps you sitting in profit long after your original idea has played out, because maybe it can double again. The pain of taking a small loss feels worse than the abstract idea of a big loss later. So you let red positions run and hope they come back. A few early wins on high leverage create a dangerous illusion of skill, and you start believing you can feel the next move without a plan. Behavioral finance studies and trading statistics consistently show that most active traders lose money and overestimate their own skill. Underneath, that is a complete lack of structure. Most people trading futures could not clearly answer basic questions about their own behavior. Are you a short-term trader or a swing trader? Are you investing or just speculating on short moves? What percentage of your capital are you willing to risk on a single idea? How much of your net worth is sitting inside one exchange? Without clear answers, every trade becomes a random reaction to price, not a deliberate decision. This shows up in very practical ways. Traders open positions with a size that feels right in the moment, without calculating position size based on a fixed risk percentage. They add margin emotionally when the trade goes against them, pushing their liquidation price closer instead of further away. They have no written rule for when to take profit, so they jump out early when they are scared and hold too long when they are euphoric. They do not keep a journal of their entries, exits, and emotional state, so every mistake feels new even when it is the 10th time. Then there is the product itself. Perpetual futures are designed to be fast. They let you take large notional positions with a fraction of the capital. Funding payments constantly incentivize traders to pile into the crowded side of the trade. Liquidation engines are automated and unforgiving. When open interest across the market is huge and price starts to move quickly, your position is not just exposed to direction. It is sitting in a minefield of other traders, stop losses, and liquidation levels that can trigger chain reactions in seconds. On top of this, the environment around you is noisy and often toxic. A huge portion of crypto content is optimized for engagement, not education. Feeds are full of screenshots of winning trades, never the full history of all the losses behind them. Many communities shill altcoins or leverage strategies with almost no discussion of risk. Short-form content compresses complex topics like funding, margin modes, and risk management into 30-second clips that feel empowering but leave out everything that actually keeps an account alive. You are also surrounded by narratives that distort your sense of time. Bull run memes, having countdowns, this is your last chance language. All of that pressures you to act immediately instead of patiently. With Bitcoin making double-digit percentage moves in days, sitting in cash can feel like failing, even when it is the most rational decision. Finally, there is the quiet but brutal math of trading. In highly leveraged markets, a series of small mistakes compound quickly. Lose 50% of an account, and you do not need another 50% gain to get back. You need 100%. When you take repeated large losses, your emotional capital erodes alongside your financial capital. You become more impulsive, more reactive, more desperate, and that is exactly when liquidation risk is highest. None of this means you are doomed to lose. It means that without a clear framework for risk and a way to manage your own psychology, the default outcome of playing with leverage in a volatile market is loss. The system is built to reward disciplined players who treat risk as their first priority, and to quietly harvest everyone else as liquidity. If you do not consciously choose which group you belong to, the market will choose for you. Here is the part almost nobody wants to hear. The market is not bullying you. It is simply revealing what was already inside you. Most traders blame liquidations on external forces. They blame exchanges for hunting stops. They blame market makers for running price into obvious levels. They blame whales, news events, influencers, anything but their own decision to risk half their account on a single candle. That mindset might feel comforting in the moment, but it is a trap. Because if everything is someone else's fault, nothing is in your control and nothing can change. Take a step back and look at what futures trading really does. It does not create greed or fear out of nowhere. It compresses both into a much shorter timeline. The same impatience that makes you swipe through social media instead of reading one deep article shows up in the way you chase entries. The same difficulty you have with saving money in the real world shows up when you refuse to take profit on a green trade. The market is not unfair, it is just brutally honest. We also romanticize the idea of a single life-changing trade. Everywhere you look, people are chasing the story where one perfect long on Bitcoin at the bottom and one perfect exit at the top flips their life upside down. But if you really look at the history of people who survived and thrived in volatile markets, their results do not come from one miracle moment. They come from being boringly consistent when everyone else is emotional. There is another uncomfortable angle. Many traders secretly treat money in their futures account as less real than the money in their bank. They top up the account from their salary, but once the USDT is on the exchange, it becomes points in a game. That makes it easier to take wild risks that they would never take if the same amount were in an envelope on the table in front of them. The problem is that the market settles in real numbers, not game points. If we flip this perspective, something powerful happens. Instead of seeing liquidation as an enemy, you start to see it as feedback. Each time your position gets auto-closed, the system is telling you, with complete honesty, that your position size, your leverage, or your exit plan was badly designed for the volatility you were facing. That is not an insult. It is an invitation to upgrade. The truth is, you cannot control when Bitcoin will spike or crash. You cannot control whether an ETF headline will hit during your sleep or whether a sudden cascade of liquidations will slam price through your level. But there are a few things you can control completely. How big your positions or how much you are willing to risk per idea. Whether you set exits in advance, whether you chase price emotionally, whether you bother to review your own behavior after each trade. Most of the content in this space talks about hunting the next narrative, the next coin, the next breakout setup. Very few people are willing to talk about something far less glamorous. The idea that the real edge might be inside you, not on the chart. That your ability to follow simple rules, to walk away when you are tired or angry, to ignore noise, could be more valuable than the fanciest indicator or the most complex strategy. So before we get into specific steps, I want you to sit with one question. If the market is a mirror, what has it been reflecting back about you so far? Are you patient or impulsive? Do you protect your capital or treat it like chips at a table? Do you show up with a plan or just vibes? The answers to those questions will decide whether the next bull run. Let's build something practical. Instead of treating this bull run like a once-in-a-lifetime lottery, treat it like a stress test for a better version of you as a trader. Here is a simple framework you can start using today to stop being easy liquidation. Step 1. Audit your reality. Before you open another position, take 20 minutes with a notebook and write down 3 numbers: your total net worth, the percentage currently sitting in crypto, and the amount parked on leveraged exchanges. Most people discover that what they call a small play is actually a frightening share of their real wealth. List the coins you hold, why you bought them, and whether each position is meant to be a long-term hold or a short-term trade. If you cannot answer why without mentioning a friend, an influencer, or a random tweet, that is already valuable information. Step 2. Decide on your maximum risk per idea. A common guideline is 1 or 2% of your trading capital per trade. That means if you are trading a $5,000 futures account, a full loss on one idea should not cost you more than $50 to $100. Use that number to calculate your position size based on your entry and stop level, instead of choosing leverage randomly. If the trade only works with 50x or 100x to feel big enough, that is a sign the trade is not appropriate for your account, not an invitation to force it. Step 3. Put risk before profit. Before you hit buy or sell, you should know exactly where you are wrong. That point is your invalidation level, and it should exist on the chart for a logical reason, not just a little bit below my entry. Your stop should be placed there, and your position size should be adjusted so that if price hits that stop, you lose no more than your planned percentage. Only after this is set do you think about profit targets. With this order reversed, your entire emotional state changes. You monitor trades to see whether they still fit your plan, not to obsess over every tick of unrealized profit. Step 4. Simplify your information diet. Choose 2 or 3 trusted sources for market structure and data and mute the rest for a while. You do not need a dozen signal groups and 30 different indicators. What you need is clarity. Focus on a few key metrics that actually impact liquidation risk: volatility, recent liquidation clusters, open interest, and funding direction. Check them once before trading sessions instead of scrolling endlessly through noisy feeds while you are already in a trade. Step 5. Split your strategies. Separate your slow money from your fast money. For slow money, focus on spot positions in major assets like BTC and ETH with clear, conservative allocation and no leverage. For fast money, use a smaller, clearly defined portion of your capital for futures. Treat each futures trade as an experiment with a written hypothesis, entry, stop, and target. When that experiment is invalidated, close it and record what happened, instead of turning it into an unplanned investment you are emotionally married to. Step 6. Review on a schedule, not only after disasters. Once a week, whether you won or lost, sit down and look at your last 10 trades. For each one, ask, did I follow my own rules for position size, stop placement, and profit taking? Did I enter because of a clear setup or because I was bored or jealous of someone else's gains? You will start to see patterns that the chart alone will never show you. The goal is not perfection. It is to make slightly fewer emotional decisions each week. This framework will not make you immune to losing trades. Nothing will. You will still get stopped out. You will still misread moves. The difference is that your losses will be controlled, your liquidations will drop dramatically, and your account will no longer live or die on one reckless decision. In a world where billions can be wiped out in a single volatile day, simply staying in the game with a clear process is already an edge. Over time, as you repeat these steps, something subtle shifts. You stop chasing the feeling of a perfect trade and start chasing. Now let us talk about the part that almost never shows up on the P&L screen: how all of this feels. There is a particular kind of silence that follows a big liquidation. The moment after you see your balance drop, your heart races, your throat tightens, and for a few seconds your brain refuses to believe the number. Then the excuses start talking. Maybe the app bugged. Maybe the exchange did something shady. Maybe the market will come back and fix what just happened. You close the screen, reopen it, hoping reality will change. It does not. Behind every red number, there is a very human story. The rent you were hoping to pay from your next withdrawal. The trip you promised your partner if this bull run finally works out. The quiet shame of telling your family that the savings you said were safe are not there anymore. The discomfort of sitting at a dinner table while someone jokes about crypto being gambling, and you laugh along while your mind replays the last liquidation in painful detail. Crypto futures amplify these emotions because everything happens faster. Gains feel euphoric and seductive. Losses feel like a personal humiliation. You might find yourself refreshing charts late at night, not because you have a trade plan, but because you are chasing a feeling, the rush of seeing green again, the relief of believing you are back. It is easy to forget that the numbers on the screen represent hours of your life converted into capital, not just points in an online game. On a deeper level, this market exposes parts of our personality that we often hide in daily life. The part that wants shortcuts instead of discipline. The part that hates being wrong more than it hates losing money. The part that would rather double down on a bad decision than admit it and start over. In that sense, crypto is not just a financial market. It is an accelerated course in understanding your own relationship with risk, reward, ego, and fear. The good news is that these realizations do not have to be crushing. They can be clarifying. When you recognize that your urge to over-leverage comes from the same place as your urge to buy things you cannot afford, you are no longer dealing with a mysterious enemy. You are dealing with a pattern. When you see that your inability to close a losing position mirrors your difficulty in walking away from unhealthy situations in life, The market becomes a mirror that can actually help you grow. There is also a kind of quiet courage in choosing to stay, learn, and become more responsible instead of walking away bitter. You are not the only one who has blown up an account, frozen in front of a red screen, or lied to yourself about just one more trade to get it back. Many of the traders you admire have done exactly the same. They just do not post those screenshots. The difference between people who stay stuck in that loop and people who move beyond it is not intelligence. It is a willingness to be honest with themselves and change their behavior. So as you listen to this, I want you to ask yourself a different kind of question. Not, how can I make the most money in this bull run? But who am I becoming each time I click buy or sell? Are you becoming more patient or more reactive? More grounded or more addicted to dopamine? More respectful of your future self? Or more willing to throw them into chaos for a spike of excitement today? Money comes and goes. This bull run will eventually end, just like every cycle before it. What will stay with you is the kind of person you trained yourself to be while you were in the arena. If you use this time to build discipline, humility, and a healthy respect for risk, that will pay off far beyond crypto, in how you handle your career, your relationships, your decisions with money everywhere else. Losing money hurts. There is no way to make that pretty. But loss can also be the moment you stop drifting and start choosing. You cannot erase what has already happened on your Binance Futures history, but you can decide what the next pages will look like. And that decision starts long before the next entry button. So where does this leave you? Standing in the middle of a wild 2025 bull run with a futures account that has seen more drama than most TV shows. First, it is important to tell the truth. This game is hard. Crypto futures combine extreme volatility, easy access to high leverage, and a constant flood of noise. They can turn even calm, intelligent people into emotional gamblers if those people walk in without structure. There is no angle here where you get to be reckless and somehow dodge the math forever. If you treat this market like a slot machine, sooner or later the house wins. But that is not the only story available. You do not need to become a genius quant, memorize every on-chain metric, or predict every move of Bitcoin to survive and grow. You do need to respect risk before you respect returns. You do need to decide that your future self matters more than the thrill of a single trade. You do need to accept that losing trades are part of the journey, but full account liquidations do not have to be. If this video has done its job, you are already looking at your Binance Futures screen differently. Instead of seeing unlimited opportunity, you also see clear boundaries. Instead of asking, how much can I make if this goes right? You are starting to ask, how much can I afford to lose if I am wrong again? That simple shift, repeated over dozens of decisions, is what separates people who are still here at the end of the cycle from the long list of accounts that quietly disappear. Here is what I would like you to do after this ends. Take a screenshot of your current futures balance and positions. Then before you place another trade, sit down and sketch your own version of the framework we walked through. Your maximum risk per idea, your rules for leverage, your routine for reviewing trades, your plan for separating slow money from fast money. It does not need to be perfect or complicated. It just needs to be real and written down. If this conversation helped reduce the casino glow around crypto, but also reminded you that there is still a path to do this seriously, then let it be the beginning, not the end. Share your story in the comments. The wins you are proud of, the liquidations that still sting, the one habit you want to change after watching this. You will be surprised how many people quietly went through the same thing and are ready to talk honestly about it. And if you want to keep rewiring the way you think about futures, risk, and this entire market, make sure you stick around. Click on the channel avatar, check the description, and if you decide to open or move an account through the exchange links there, use them consciously. Take any bonus as extra protection, not as fuel for reckless leverage. Trade with understanding, with position sizing, with respect for the worst-case scenario, not with blind hope. In the next videos, we are going to go even deeper. We will break down real liquidation cascades, walk through how large players structure hedges, and explore how to build a futures routine that fits a real life, not just a fantasy of staring at charts all day. If that sounds like the kind of journey you want this bull run to be, then you already know what to do. Take a breath, close the chart for a minute, and when you come back, trade like someone who intends to still be here long after the fireworks are over.